Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Well, Houston, we have a correction. Welcome to episode 127 of Carson's Facts versus Feelings. Ryan and Sonu, we're titling this one Correction. How worried should we be? Sonu, but before we go there, it's March Madness on the YouTube channel. I'm wearing my Xavier shirt. Who knows? By the time people listen to this, Xavier might have lost. We snuck in to the tournament, playing up in Dayton, Ohio, an hour north of where I'm sitting.
Congratulations.
Yeah, playing Texas. And Ohio State took out Texas in football, so maybe another Ohio team will take them out a different sport. We'll see. But you went to Purdue, and we joked last year. You didn't even know Purdue had a good basketball team, but, you know.
I knew it was good when I was there,
Yeah.
but the women's was better at the time. And I was this was like, oh goodness, about 25 years ago.
Yeah.
I feel old. I feel really old.
Well, you know. Yeah, like I always say, you're older than me. Sonu's like 6 months older than me. I point out to him he's the old man of this podcast. He's 6 months older.
I'm graying all around here. But,
yeah.
You know.
Well, that's probably because we're in a correction. Let's just dive into it.
Go.
So we'll talk about marketing correction, a bunch of stuff, then probably a little macro stuff the second half. But set the level. You know, we hit an all-time high February 19th on the S&P 500, and then 16 trading days later, we hit into marketing correction, and that means down 10%. By the way, down 10% from the all-time highs. It was.
Is that a hard and fast thing? Like 10% is like somebody.
Somebody.
Is it like someone on CNBC or something like that? Like, okay, we have a correction.
Yeah, I
always think 5% pullback, 10% correction.
Yeah.
I don't know what 15 is, but 20% bear market.
Yeah, somebody came up with that long before us, and I guess we just run with it. You got to have definitions somewhere, so I get the flaws and like, is it a bear market? Well, in 2011 and 2018, intraday, we were down 20%. We rallied on those days, so technically it wasn't a bear market. We get those, but, you know, I kind of liked it. You know, I mean, let's just put it this way. I know, Josh, the chart, we can share it on the YouTube channel. What happens after stocks move into a correction? That chart, we can share that one right now. Again, 16 days into a correction is what this took. But the fascinating thing, Sonu, to me, I found, I think it's 11 or 12. It's 11 or 12, honestly. I think it's 12. 12 other times we went into a correction but did not go into a bear market. All right, so we're sharing that on the screen on YouTube. 5 of them bottomed the day you went into a correction. How about that? I mean, like, because a lot of times, yeah, there's still more weakness and this and that, but 5 times out of 12, you bottom. So did we bottom on Thursday? Listen, I don't know. Who knows? Maybe
Thursday of last week.
Thursday of last week before the
13th.
Yeah, before the huge rally on Friday, a solid rally. And what got me, and I'm not calling him out, I hope, because I want to have him on our show, but I got to be careful how I say this. Huge fan of Ed Yardeni. I think he's like one of the biggest bulls out there. I read Ed's stuff, big fan, watched him for decades.
I thought you were going to talk about Harry Dent.
We can talk about it. We can poke at Harry Dent more. But on Thursday, Ed Yardeni said the Trump put is kaput. Kind of cut some of his estimates. Kind of started talking a little worrisome. Didn't cut his GDP, but he said he might.
Words.
Yeah, you like that? Well, that's why Ed's awesome. Come on our podcast, we can talk about it. But you know, so I said, wow, one of the biggest bulls is kind of waving a little bit of white flag. That's something. And then on Friday, everybody's friend Harry Dent came out and said stocks are going to fall 99%. Certain stocks are going to fall 99%. And I'm thinking to myself, wow, you've got a big bull waving the white flag. You've got the biggest bear out there making some real. And by the way, you can Google,
doing what he does and going.
Google Harry Dent. You can see what he's been saying for a long time. You know, he's been bearish for a very, very long time.
He was bullish across the 2000s.
Yeah, how'd that work out? Yeah, he was very bullish in the 2000s.
It was like the roaring 2000s.
Which was a lost decade and one of the worst. Literally, the 2000s was the worst decade for investors since the Great Depression. So anyway, so we've got Harry making comments like that. You have the AAII sentiment poll above 55% bears 3 weeks in a row for the first time since March 2009. We finally saw put-to-call ratio spike by a wide margin last Thursday. Just this morning, haven't had a ton of time to look into it, that global fund manager survey from Bank of America showed huge drops in overall bullishness and optimism. Now, everyone was thinking the economy was great 2 months ago. Now it's like, whoa, not so sure. So to me, it's just a shakeout. We've talked a lot about how early in a post-election year. I was on CNBC like 5 a.m. this morning. So who knows how this podcast is going to go. I'm kind of tired right now, to be honest. But talked about this early in a post-election year. Choppiness is normal. Early after 20% gain, choppiness is normal. The past 20 years, choppiness is normal. Sonu, last thing, I'll let you talk. The last 20 years, S&P's bottomed on March 12th on average. That's skewed because of 2009 and because of 2020. We get it. But at the same time, we bottomed so far on March 13th. I don't know if it's that simple, but we've said on this podcast the last couple of weeks, late February, early March weakness, perfectly normal. Market in a correction, just pure hysteria out there on a 10% normal correction, which happens on average once a year. And then we started to bounce a little bit. Who knows what's going to happen from here? I'm not saying where the low is in, but I think we're closer to a low than not. Oh, one more. The cover of Economist is President Trump with the flamethrower burning up dollar bills. Okay, that's not a very optimistic cover. I mean, that tells you where sentiment. Now, the Economists, they're kind of that way. But still, when you see these things, I'm
maybe
thinking,
he does want to burn dollars.
Well, you were looking into it a little bit more. You're like, well, doesn't he want the dollar to go down? Like, I don't know. Yeah. All right, Sonu, what do you think about some of the market stuff that's going on out there?
I'm going to bring up something our friend J.C. Perret said. When we talk about market in a correction, let's be specific. We're talking about the S&P 500.
Yeah, good point.
There are a lot of stocks that are up. Look at the developed markets. Look at Germany. Look at Europe. All of that. The MSCI EFA index, which is developed markets. It's got Japan, Europe, Canada, Australia, all of that. From February 19th through March 14th, when the S&P 500 fell, it's the time we went into the correction. Performance since February 19th, S&P 500 high, right? The MSCI EFA index is up 1.5%.
Wow.
Positive, right? The S&P 500 low volatility index is flat, negative 0.1%, right? You and I have talked about how we added some of that low volatility exposure before the election, actually. We've been in this now for about, I'm trying to count, 4 months, more than 4 months, 4.5 months. You're sitting here on March 18th. And then we talk about, that you don't have to be in one side of the market. Even an equity portfolio, we usually talk about diversification. We talk about diversification across asset classes. And gold has done well. Bonds did relatively well during this period when stocks fell 10%. When the S&P 500, I should say, fell 10%, right? So you've had your diversifiers working for you, and they're zigging when stocks are zagging. But even within equities, right? You don't have to be all in on technology. You don't have to be all in even on the S&P 500, right? There's broadening, and that's something you and I have talked about. And, if we discuss this in the outlook too, you don't have to be all 100% exposed to U.S. stocks, for example.
No, I mean, believe me, it was nice if you were the last 2 years, but we've been saying, things could be changing a little bit. We'll share on the YouTube channel now the table, one of the fastest corrections ever. Now what? So again, it took 16 trading days. Okay, so as we're sharing on YouTube, but I'll explain to the listeners, 6 other times, Sonu, we saw a quick correction from an all-time high to down 10%, like we just saw. The fastest ever, look at my phone here, was 6 days during COVID. So not surprised. This was 16 trading days. But here's what really matters, I think, to listeners out there. 3 months later, after a very quick move from all-time high to a correction, higher every time, up 7.5% on average. 6 months later, higher every time, almost 15% on average. So snapbacks, whatever you can call it, back a strong rally coming back after a quick correction, as scary as this quick correction has been for a lot of people, especially those that weren't diversified, like you said, maybe just sitting in Mag 7 because, hey, it worked, now it's not. That's what this feels like, I think, to a lot of people. But one more thing, and I'm going to share this now on the YouTube channel. The past 2 days, how strong they've been. Now, the past 2 days, let's be clear, that's Friday and Monday. So we saw Friday was the best day of the year, up over 2% for the S&P. Over 90% of stocks in the S&P were higher. Followed through on Monday with more than 90% of stocks in the S&P 500 higher on Monday. That's back-to-back 90% up days on the S&P. That is extremely rare. Thanks to our friends over at Ned Davis Research. I used their data going back to 1972. when you look for back-to-back 90% up days, as again, we're sharing on the YouTube channel there, 6 months later, higher 10 out of 11 times, up double digits on average. A year later, you're up 16%, higher 10 out of 11. These are just all these little stats by themselves, take it for whatever they're worth. But when you start stacking them on top of each other, to me, it suggests, again, 6 months from now, we're probably going to be up a good deal, and maybe next month, maybe we're not. I know the headline risk is there. News trumps charts. We get all that. But some of the things that we are seeing here with the seasonality and the over-the-top negativity and now a potential buying thrust, those are appealing to me from that point of view. But I guess my question to you then, Sonu, let's say the U.S. bounces. Oh, heck, what did I just say it was? Like almost 10%. 10% the next 6 months. Let's say it's 10% the next 6 months. Are they going to lead? Or is Europe still going to lead? Or China? Or the dollar? Or not the dollar? Gold? I mean, what do you think will happen? Let's just play hypothetical. U.S. does bounce 10% the next 6 months. Where would you want to be?
And speaking of that, like you just mentioned, I will answer the question. I'm not going to avoid it.
Well, I joke. Sonu and I did a podcast last week. He didn't even answer the question. I was like, God, you're getting good. You're like me. They ask you something. Like I always say on TV, they say, when you go on TV, they say, do you know what they're going to ask you? I said, no, but I know what I'm going to tell them. That's my saying when I go on TV.
But here it's just two of us, right?
Yeah.
Amongst friends.
Yeah, amongst several thousand people listening.
To us.
Yeah.
So... But no, look, one thing, you said this yesterday when you were on a call with advisors, stocks take the elevator up, is it? No.
So what
elevator up and escalator.
Listen.
No, escalator up, elevator down.
Listen, everyone, I just want to point this out. Yesterday was St. Patrick's Day. All I know is there was one or two of us that might have been in Chicago. It took like a 3-hour lunch with a partner in town. I said, I don't know. Or you might have had a few drinks. I don't blame you. It's St. Patrick's Day. No, it's the old saying.
Help me out here.
I'll get there. I'll get there. The old saying, investors take the escalator up, but the elevator down. So there we go.
But 6 months forward after that, it kind of takes the escalator up again, right? And that's what your numbers show. Like 10%, the 6 fastest corrections.
Yeah.
And then it takes next 6 months, it comes back. So it sort of doesn't pay to, condition this. I don't know what's going to happen, but still, it doesn't pay to like sell over here and panic.
Yeah. Right.
Right. Because it's going to recover. And if you sell, you may miss a good chunk of that recovery. That's the other side of it. Yeah. Right. Now, with respect to will the U.S. outperform everything else? So far, it hasn't, at least year to date.
Sure.
And, you hate saying this time is different, but I'll put it this way. And this goes to how we're positioning our portfolios as well. So that's our answer, right? What we are doing in our models.
Right.
There's a lot of uncertainty. We don't know. So we've pulled back to a maximally diversified portfolio. We're still overweight equities. Yep. Right. In an unconstrained model, we are 75% equities, 25% diversifiers, right? We used to be like 85, 90%, right? We pedaled to the metal for the last 2 years. We'd pulled back actually before this, correct? This is a few weeks ago.
Oh, yeah.
We've done this, right? But at the same time, we're not, neutral for us is 60-40. That's us, if we didn't know any better, we'd go to 60-40. We're still positive on equities, so we're 75-25. But out of that 75, a good chunk is in international equities, maybe close to about 20% or so. Okay. And so, and then out of the remaining, what is it? About 45% U.S. equities, or 55% U.S. equities. I would say a good chunk of that is in momentum stocks. Yep. And this, during this correction, one thing we have seen, even year to date, momentum has actually done better than high beta.
Yes.
You have very high cyclical stuff, right? The S&P 500 high beta index was down about 16-17% during this correction. Momentum didn't get hit as hard. And you usually think, wait a minute, isn't momentum the same thing as high beta? Not quite, right? Sometimes it can look that way because momentum can be, a shapeshifter. It can be anything really, depending on, how those particular stocks have done over the last 6-12 months, right? But now momentum actually has financials. Financials is, are the group that have a lot of momentum. And so that's what momentum, essentially has. Whereas high beta is all the other stuff that's, richly valued, etc., growthy type stocks. That's all gotten hit really during this correction. So when financials are doing relatively better, momentum's doing relatively better, I think that tells you that this is a growth scare. This is not a recession scare, right? And I think that's what we are looking at, from a perspective of portfolios as well. So to answer your question, I guess it's really like we don't know, but we are positioned for. We don't want to be left behind if A or B rally, whether it's Chinese stocks or whether it's European stocks or even if it's US stocks, right? But right now, uncertainty is high, and we want to be positioned with maximum diversification.
No, well said. I mean, 2017, right? U.S. did really well, but the rest of the globe did really well also as the U.S. dollar went lower. I think U.S. plays catch up. Yeah, I don't know. Next 6 months, maybe U.S. does a tad better than the rest of the world, but I think the rest of the world is starting to do pretty well, right? As that dollar keeps going lower, so being diversified makes a lot of sense. Josh,
and that's a kicker too, right? If the dollar goes down, and that's why I was like, when the Economist put that cover, I was like, the Economist is probably trying to make a joke here, trying to be sort of trying to play with on the negativity. And I was like, you know what? I actually think they probably want a weaker dollar because in the administration's mind, it's very unclear what they exactly want. But from what they've kind of said, it seems like they want a weaker dollar because it promotes U.S. manufacturing. Now, I think then, we've talked about how with tariffs, it's a stronger dollar that actually helps mute that inflationary impact. But if you have a weaker dollar, then you have, more inflation technically, right? Because it makes foreign goods that much more expensive. But, we'll see where all that plays out. I think if the dollar goes down, going back to what we were talking about, that is a tailwind for international equities.
Yeah, no doubt about it. Also, a chart I thought of that maybe we could share. We'll share this on the YouTube channel. Josh, I'll get it to you, but just mark the time down. If you missed the best 10 days of the year, because we get this a lot, right? If you miss the best 10 days, miss the worst 10 days, here's the thing people need to remember or need to know. The worst days of the year and the best days of the year, Sonu, happen about the same time, okay? Just like last week. Monday was the worst. Friday was the best. That's how this works. So if you sell because you've had some big down days, which is what I've seen throughout 25 years of my career, that tends to be what people do.
And usually best is after worst, right?
The best is after the worst, and then you get the rip higher. So again, we're sharing on the YouTube channel now, but if you miss the best 10 days of the year, since 2000, S&P's up about 9.8% on average. Let's just call it 10%. But you miss the best 10, that drops all the way down to negative 12.5. So you're talking a 20% drop. Just the last 2 years, right? Up about 23, 24%. Those drops the last 2 years go to about 3 or 4% if you miss the best 10 days. So, of course, if you miss the best 10 days, of course, it's not as good. But what if I miss the worst 10 days? Listen, if you want to play that game and do short-term trading, be our guest. You're probably listening to the wrong podcast, to be honest. There's probably some other podcast for that. What we're trying to stress to our Carson partners and the clients and people out there listening, if you're going to miss the best 10 days of the year, you're in trouble. They tend to happen after the worst days of the year, okay? So think of August last year, all right? August last year, really big. That was the biggest down day, 3% down day. I don't know the exact day, but I think that first Monday in August. And then like a couple days later, had like the biggest day of the year, all right? So, and again, speaking of August, there was a day when all that credit crunch stuff, yin carry trade stuff ended. We had an up 90% day on the S&P 500 and an up 90% day on the multi-cap data that Ned Davis keeps track of. So you got, large caps, and you got everything up. That was a one-day period that marked, that's it. The yen carry trade worries are over. We just saw that on Friday. We saw a 90% multi-cap, everything that Davis looks at, along with S&P 500 at 90%. Hey, don't know if that's the low or not, but I'm optimistic, I guess, that'll be the case. And there we go. Thanks, Josh. Here we go. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can leave a review. We love your feedback. And the one we did last week, who'd we have on? I can't believe I just forgot his name. Sorry, Warren. I've been up forever. I don't know what I'm saying anymore. Our buddy Warren Pies joined us. We hit a record number of YouTube views, which is awesome. The number of downloads to the podcast has been really good too. But we're trying to really do a lot more with YouTube there. So thanks to Warren for joining us. Thanks to everyone that listened to it, because it was the most we've ever had. Literally, we've done 126 of these. This is 127. That was the most views on the YouTube channel we've ever had. So thanks to everyone out there. Give us those likes. Give us those reviews. There's a rumor we might turn comments on sooner than later. We're not there yet, but there's a rumor we'll have comments on, which I've heard the magic elixir to better algorithms is having the comments on. I don't care if they're good or bad, to be honest. Whatever. Just make comments, but they're not open yet. We'll let you know. People. Whatever. We'll let you know when those comments are on YouTube, and comment away, because algorithms love that, but we're not there yet. But we are pushing to try to get that approved. Not there yet. All right, Sonu, we've gone all over the place. What else you want to talk about?
Actually, let's just stay on the topic of stocks. I was going to ask you something. I think it was a couple of weeks ago, maybe 3 weeks ago, we talked about tech stocks, right?
Yeah.
How tech stocks have been flat for like 8 months, and now it's been flat for about 10 months because of this pullback. But when we talked about it, it was flat for about 9 months at least.
Mm-hmm.
Do you think the market is trying to say something here to us? I mean, and then we just talked about low vol stocks, defensive stocks sort of, rallying over the last 4 months too. And so it's not just before this correction, right? It was already doing well. Mm-hmm. I'm curious what signal you take out of that.
Mm-hmm. I guess it's not here's the thing that might surprise some people. It's not all that surprising because last year, technology stocks underperformed the S&P 500. Mm-hmm. It was like 23.5 to 23.3. Not by a lot, I get it. But I think that'd be surprising to a lot of people because tech, it did great. Yeah. So
Magnificent Seven, all of that.
Yeah,
right?
But then the fourth quarter last year, we started to see some pretty good size underperformance from technology. Clearly, things kind of broke so far this year. So that's not surprising, I don't think, to see that. Now, the big question, and I get it, tech is, 30% of the S&P 500. You got another 11 or 12 in communication services, kind of a cousin to tech. So that's like 40%, if my math is right. If those two groups fall apart, it's going to pull probably the market down. But as of Friday, and I don't know, maybe but as of Friday, 7 of 11 sectors were up on the year. After Monday's rally, it might be higher, might not. I'm not sure. But it is, You're
right. It was 7 out of 11.
Still 7. So 7, 11. There you go. So 7 out of 11. That's not terrible when you see a market in correction. Stocks are down. I will say this. I've had some friends reach out to me that I haven't heard from years. I mean, literally like years. They know what I do, whatever. Reaching out, panicked. Over the weekend, I was getting messages from people. I was like, wow. I hear from people like this, no offense to them, when we're closer to a low than not. We all do this. You hear these little anecdotal things, and I'll tell you, I was hearing some things from people getting really worried, rightfully so, with all the scary headlines and all the uncertainty that's out there. But, well, then we're looking at 2 pretty good up days. So, bottom line, I guess, the fact that we are passing the baton around, as I like to say, is a real positive. It's not like the whole market's just collapsing. Obviously, like you said, Germany's sitting on all-time highs, China's multi-year highs, Hong Kong multi-year highs. Like the joke, I think maybe I was on the podcast, like India and the United States are the only 2 things really struggling this year, and you're connected to both, so you're just bad luck. I don't know.
Exactly. But gold's doing well.
Oh, there you go. That's a good comeback, brother. That's good. That's good.
By the way, my name, I was sharing this with you. I can't believe I never said it. Sonu.
Yeah.
It's actually off of like in Hindi, it's Sona is gold. Right? So there you go. Like that's a good luck charm right there.
What's your middle name? Do you have a middle name? Yeah.
Sam.
My middle name is Sam. I knew that.
Middle name is Sam. Yeah. Okay. We have no originality where, this little neck of the woods that I'm from. My dad's name is Sam. Like it's Sam Varghese is his actual name. His brothers are Sam Philip, Sam Thomas, Sam George, like Sam Alex. So but my grandfather's name was Samuel. Okay. And his dad my great grandfather was also Samuel.
Wow.
My son's name is Sam. So we're all like,
that's a lot of pressure.
Full
you don't want to be the one to break the string. Well,
I wasn't.
My father's name was Orva Homer. So
really, wow.
Orva Homer. Orva. I mean, both of those are kind of, I don't know.
Very interesting.
Yeah, thankfully, I'm not Orva. You could be talking to an Orv right now. I don't know. The good thing is, like, like you're Sonu. Like you've got kind of like you're like Madonna in this industry. It's a small little bubble we live in. Oh, there's Sonu. I guess Detrick, people kind of know me, but like Orv would be like Orv. Like, okay, there's no other Orv in this industry.
Nobody
there. But anyway,
you could have just gone with one name then.
Really, really cool. Oh, you know what? I totally forgot. Should have mentioned this. Don't know why I thought of it until right now, but we're gonna do a little promo for a second. If you're listening to this, hopefully when it comes out Wednesday morning, pay attention. If it's after Wednesday, we missed it, but that's okay. We're doing a very special live stream. I guess it'll be today if you listen to it. Let's just put it this way. Wednesday, March 19th, 10:30 Central, 11:30 Eastern for 2 hours. We're doing a special Facts versus Feelings live with, I'll let you kind of introduce who it is, Sonu, in a second, with 4 true women leaders for Women's History Month, 2 from Carson, 2 kind of external Carson, I guess, if you will, to talk about all things markets, all things being a woman in this world, in the world of finance, trials and tribulations, things learned. It's going to be really, really fun. We're excited about this. So if you hear this on Wednesday morning, check out the podcast or the live stream in a little bit, but we'll share this live stream all over the place. You'll probably hear it. Some of the segments on this very podcast down the road. But Sonu, jump in there. And who all do we have join us over the course of 2 hours?
So we have two market strategists. I guess they're both market strategists in a way, right?
Yeah.
Jess Menton from Bloomberg.
Mm-hmm.
She's writes some great pieces. I mean, she used a lot of your work too.
Yep.
And then Lindsay Bell. Lindsay's fantastic. We've talked to her, I feel, not on the podcast, on Spaces. Yes, Lindsay Bell. She's also a fantastic market strategist. So really pumped to be talking to them. And then our very own, Debbie Taylor.
Yep.
Right? We're going to talk about her career or life as an advisor. It's really life at this point, life as an advisor. And then how she is sort of mentoring other advisors right now, and how to, how they can make their practices grow and help clients, and especially in the realm of taxes, right?
Exactly.
We talk about, markets and markets going up like it has the last 2 years. And one impact of that is you have to pay taxes on capital gains and things like that. How do you sort of, help investors think of minimizing things like that, reducing the tax cost and stuff like that? Right? How do you get alpha from a place of the market that is completely non-correlated with, we are always trying to get alpha from markets like, hey, maybe we overweight tech or, Germany or whatever it is, right? That's the type of alpha we're looking for. Where here is what Debbie is thinking about is completely different. It's like, let's get, alpha from a completely different source, which is tax alpha. How do you reduce tax costs? So we're really pumped about that. And then our very own Kate Hall, she leads our alternative assets due diligence. We talk about public markets all the time, but there is a very big private market, right? A lot of companies are not public. Kate is really digging into a lot of that stuff, digging into figuring out which managers really know these different niche spaces, whether it's, real estate or private credit and private equity and venture and all of that. And we'll talk about how it all comes together in a portfolio too. That's what I'm pumped about. So I think we've got a nice little arc of, we've got everything there, really.
We wanted to just go all different routes there. Lindsay's at Clearonomics now. I've known them and used them when I heard she went there. I thought it was a great fit. Jess is literally like an anchor on CNBC. She writes. She's on the Bloomberg. Did I say CNBC? Bloomberg. Get them mixed up. Sorry. Can't mix those two up. But she's on Bloomberg Radio. She's on Bloomberg TV. Does a lot of writing. And then of course the tax. I think I'm going to paraphrase what Bert White, our CEO, says. Is tax is the last great alpha out there, and we're going to learn a lot more about how Debbie has been so very successful in building her career and her practice.
Unless you're with us, right?
Yeah, well, that's true. This podcast is great alpha, along with Debbie and tax, and then Kate on our team's amazing. Talking about some things, to be blunt, we don't usually talk about on this podcast, but I think it's extremely important because we're not really experts in the field that Kate is. That's why we don't. All right, Sonu, we've probably got 10 minutes. Let's try to wrap this up in 10 minutes. We've done a lot of market stuff. You want to talk about Fed, economy? What do you want to go for the next 10 minutes?
Talk about, you mentioned, it was a good segue. We went in a totally different direction.
Yeah, who knows? Who knows? But literally before we started, I was like, what do you want to talk about? He's like, I don't know. So literally, this is the most unscripted podcast we've ever done. Yeah.
So you said people are scared. I mean, people have been coming to me as well. Like people I usually never talk about markets and things outside of my life here in this room, really, or when I'm with you or advisors and things like that, right? Because it gets really heavy really quickly. And how much do people really want to, hear about that? But like you, I've been hearing a lot about, oh my God, like, should we panic? What should we do? And I say, just listen to the podcast. And they have.
I like it. My other joke was going to be, you should just be like, well, in the Fed Beige Book last week, their eyes will glaze over. They will just bring up the Fed Beige Book. They will leave you alone if you want to get out of that conversation.
But on that, let's talk about sentiment, consumer sentiment, right? Consumer sentiment. So a couple of, there are different ways of measuring it. There are different people who measure it. We have the New York Fed. We have the Conference Board. We have the University of Michigan Index. The University of Michigan, to Ryan's chagrin, is the one that is the most popular one, the most cited. Even though it's like, I mean, no offense, it's a very long-running survey as well.
Yeah.
I think it's a reasonable one, but I prefer like the New York Fed survey. But still, it's not about what I prefer, or it's about what everyone else is looking at, right? So the University of Michigan Sentiment Index just collapsed in March. Fell about 7 points to about 57.9. Doesn't matter what the numbers are. It's more than reversed its gains, not from just post-election, over the last 2 years. It's been rising. It always has those dips and things like that. We'll put up a chart on this as well, right? This is the Consumer Sentiment Index, University of Michigan, Josh. I mean, if you want to throw it up. So there are two things that drive it. One is how consumers feel about where things are right now. It's called the current conditions index. The other is how they expect things to be in the future. That's the expectations index. Both have gone down, right? And the other part is consumers also expect stagflation. Now, what is stagflation, right? Stagflation is, if you think, okay, it's what happened in the 70s. What happened in the 70s? You had rising inflation and you had two big recessions in there where you had rising unemployment. So you have two conditions for stagflation: rising inflation, rising unemployment. Let me be clear, we don't have either of those things right now, right? And we can talk about why if we have time. But consumers think the 1-year inflation expectations jumped from 4.3% to 4.9% in March. That's the highest since November 2022. Remember, 2022 is when we actually had high inflation.
Right.
We don't right now, but consumers saying, oh, you think 1 year ahead inflation expectation will be 4.9%. 5 year ahead inflation expectations, which tend to be a little more stable. And that's why the increase is a little concerning, because the Fed looks at the stuff too and like, but that jumped to 3.9%. That's the highest we've seen over the last decade. That's crazy. It's higher than where it was when we actually had a lot of inflation.
That doesn't make a lot of sense, but then again,
but where it does make a little bit of sense, and I'll come to the unemployment side, but part of it is a lot of this is colored by politics.
Well, that's exactly
right. Democrats expect, inflation to be 6%, 6.5%, whatever it is. It's a very high number. Republicans are expecting 0% inflation, which is almost a deflationary recession type of conditions. I think the signal is actually with independents, right? If you just, forget Republicans, Democrats, put that aside. Look at the signal from independents. That's actually rising. Same thing. Unemployment, inflation expectations for 1 year ahead inflation and even long-term inflation expectations have gone up. So that is, like, if you ask me, I am not too concerned about it, honestly. I just stop. But I'm concerned about it from the perspective that I think the Fed is going to look at it and start getting worried. They'll be like, we can't reduce rates, right? Then the other thing is consumers expect unemployment to go up as well. Now here, I think there is a little bit of a signal,
right?
Even independents, right? It's not just Republicans, or it's not just Democrats. Republicans don't expect unemployment to go up, and Democrats do. But forget those two sides and just focus on independents. And I have this chart. Josh, you can put this chart up. This is from the Wall Street Journal. I think it shows unemployment and inflation expectations for independents. So consumer expectations of unemployment is actually, it's not a bad indicator. Neil Dutta talks about this as well. And consumers are actually the first one. Before you and I look at the data, we look at the unemployment rate, we look at initial claims data for unemployment benefits. It's like a leading indicator for the labor market. And I say, okay, things are fine now. But what Neil's argued, that consumers see, people around them. And they are the first ones to see if people around them are getting laid off. Right? So when consumers tell you that the labor market is not going great, there's some reason to be worried there. So am I worried that there'll be a recession at the end of the day? No, I'm not. I think the probability of a recession, maybe at the beginning of the year, I was at maybe 15%.
Okay.
Right now, I may be like 20%. Right? I don't think, that's far from the base case of a recession. Doesn't mean there'll be there won't be a slowdown. I think, yes, we will see that. But we weren't expecting 3% growth at the beginning of the year when you and I wrote the outlook, right?
Right.
We were expecting maybe, something closer to 2%, maybe slightly higher, but maybe we are slightly under 2% for the next 6 months, 9 months, or even rest of the year. So I think the rest of the market and investors are just re-rating growth down. Is it a time to panic? Goes back to what we were talking about. Look, if you're concentrated in one side of the market, it looks very scary. I think a lot of people are. This is a time where I think you want diversified portfolios, right? Uncertainty is high, and that's when you want diversification.
Well said. Again, this is episode 127, Carson's Facts versus Feelings. Correction, how worried should we be? And like Sonu just pointed out, I guess if you're chasing the shiny objects from the last few years, maybe you should be a little more worried because, as we've seen throughout history, the leaders 1 year are not necessarily the leaders the next. That's why you should be diversified. I do want to spend maybe 90 seconds here. I've been compiling a lot of things which I consider to be over-the-top negativity. And I just, I hopefully I can read my own writing when I do this. I'm just going to start listing some of these off.
I have a question for you after that.
Okay.
Go ahead.
Let's do it. I'll try to do this quickly here. The Ned Davis Research Trading Sentiment Composite, lowest since COVID. Bill Maurer, I like Bill Maurer. He's a pretty funny guy. He talked about the stock market at the start of his show last Friday. Not something he normally does. Harry Dent, stocks are going to fall 99%. Goldman Sachs prime brokerage arm hedge fund saw selling at a record, I can't remember writing, record selling of equities. Ed Yardeni, the Trump put is kaput. He cut his 7,000 target this year to 6,400. Investors Intelligence, largest 2-week drop in bulls that they've ever seen. Bears are larger than bulls for the first time, or more bears than bulls for the first time since November 22. Consensus is another survey. Lowest number of bulls dropped 11 points. That's the largest drop in 10 years ex-COVID. S&P Global IMI survey. I don't even know what it is, but I saw it. One of the lowest levels ever. Equity put to call ratio Thursday, 0.94. Spikes up around 0.92 or more have marked some near-term lows historically. University of Michigan, you just mentioned it. Labor expectations, lowest since 2008. That's not very optimistic. Trade uncertainty index is the highest ever. Economic policy uncertainty, second highest ever. Michigan consumer confidence has the lowest level since 22, and a record drop in business expectations. There's more. I mean, isn't this amazing? Citigroup Global Risk Factor is the highest since 22. QQQ, the ETF, had its fourth highest volume day ever. Tends to happen when things are worried, when things are scaring, but also when things tend to bottom. The AAII, already talked about it, 3 straight weeks of bears above 55%, first time since the lows in 2009. The Ned Davis itself reduced their U.S. equity exposure 10%. CEO confidence dropped 7.2. That is the largest drop in 3 years. The NFIB uncertainty at small businesses, second highest level ever. I'm almost done, I swear. Goldman, Morgan Stanley, JP Morgan all cut GDP forecasts. President Trump is literally burning U.S. dollars on the cover of The Economist magazine. And the Fed's own beige book, your favorite reading to put yourself asleep, Sonu, said the word uncertainty 47 times, an all-time record. And that's not even including the Goldman, the report that came out this morning, Global Fund Manager Survey, which saw some of the largest drops ever. I know that's a lot, but that's what we've seen literally the last 7 days.
That?
No. Yeah, God, no. God, I could barely read half my writing. But that's just the last 7 days. That is why everyone's worried, because everybody's seeing that stuff out there. The market's in correction, all this stuff. But just remember, the market's a forward-looking mechanism. Could things get worse? Sure. Things could get worse. Could we go into a bear market? Sure, we could go into a bear market. But I love to look at the market from an expectations point of view. Those are some lowered expectations, and a lot of the things I just mentioned had marked lows, significant lows throughout the last 10, 15 years, and a lot of them are triggering right now. So just something to think about, for everybody out there. So, yeah, we're kind of at the end. What else do you want to talk about before we sign off here?
Just one question for you. Scale of 1 to 10, 0 to 10. Zero being 0 to 10. 0 being not worried at all.
Okay.
10 being extremely Harry Dent.
From 0 to Harry Dent. I got it.
Where are you right there?
In terms of equity markets or economy? Because honestly, I might have a different answer.
Let's do equity markets. I'll actually do both. Equity markets and economy. I'll do both. Two
on equity markets, because I think we're pretty close to a low. Economy maybe more like a 5. And I'll be honest, I was on a podcast earlier today. I've been talking all day, it feels like. And they asked this and that, and I kind of gave some answer. I don't know. I don't think I like my answer to be blunt. But the other guy said, a lot of this could change right now with President Trump's policies. Like, this could change in a hurry, right? Now, it can go both ways. I mean, that can go both ways, right? But it's just hard for me to think they're just going to continue to push on this stuff. April 2nd's a big day with the tariffs and all the uncertainty. Maybe we get some good news on some fronts here, and that can be a positive. But the economy, I'm more worried about the economy and the slowdown and self-fulfilling prophecy, if you will, of consumer confidence and inflation expectations. But from a stock market point of view, you want to buy lowered expectations. Last thing, I'll never forget the headline. Well, I guess clearly I forgot it already because I don't know what I'm talking about. It was Jim Cramer, on his show in, I think, April of 2020. It says, record number of people lost their job last month. And at the bottom, it says Dow had best week since 1938. All right. It's a famous image. I've used it in presentations before. Actually, maybe assuming compliance lets us share it. Josh, I'll share that right now too. So I don't see why we couldn't. It's CNBC. Yeah. Anyway, we'll share the image, but it's Jim going nuts about the market going crazy, people losing their jobs, the economy going crazy, going down, people losing their job, but the stock market had its best rally since 1938. These things don't always make a lot of sense, okay? Markets can go up on good news. They can go up on bad news. They don't like uncertainty. If we just get a little more certainty, and maybe it's tariffs or 75%. I'm not saying it's going to be there. Just let us know. If that's what it is, that's what it is. You've said before, companies are going to find a way. Now, 75% is too extreme. I get it. But you know what I'm getting at. Just give us clarity on where it is. And companies will find a way and consumers will find a way. It might knock the economy for a minute. But I don't know. I'm optimistic we're still going to find some good places here.
Average of what, 2 and 5. So 3.
Let's
say 3.5.
You know, right? I'm never that worried. I'm more worried about this right here. Yeah. Xavier's game tomorrow against Texas. That's what I'm worried about. Okay, that's what I'm worried about right now. Yeah.
So I'll tell you my score. It maybe tells you something about how both of us look, what we look at. You're a little more worried about the economy, less worried about markets. I'm a little more worried about the markets and less worried about the economy.
There you go. That's why we have a podcast.
But still, for me, the economy would be at 4. And markets would be at 3.
Okay. Yeah.
Right. And by markets now, I'm kind of cheating here because I'm thinking about everything. I'm not just thinking about the S&P 500.
I was focusing more on S&P, I guess. I see what you're saying. I cheated
there.
Yeah.
But I'm looking at everything. There's Europe, what's happening in China, what's happening at low volatility stocks, all of that, right? That's what is like. If you just ask me, like, what are you? How worried about you are you about the S&P 500? Then I'm thinking, it's got 40% tech and tech adjacent stuff, and maybe it would be a 5 for me just from that perspective. But if overall stocks as a whole, you don't have to be just in the S&P 500, and we are not. Right? So, I said, I cheated a little bit there, so that's why I said 3 and 4 for the economy. So yeah, base case, I'm not worried. I'm not too worried. Yeah.
I mean,
not right now. That could change.
It could change. And the good news is you and I do these podcasts every single week. So if it changes, we'll let everybody know. Again, this was episode 127 of Carson's Facts versus Feelings. The exact title was, where is it? I've got it written down somewhere. Correction. How worried should we be? Thanks to everybody out there. Thanks to Josh, our producer, for getting this out there. And I got up like over 7.5 hours ago. It's still early because I got up. I need a little sleep, but I need some food.
And you don't even drink coffee. No, that's the thing. Get a milkshake.
Maybe. I don't know. I'm thinking. When you get up that early, I am starving. So listen, I've been on the go all morning. I need a little time to chill here. So hopefully the podcast made sense, everybody. We really appreciate the listeners and leveraging the YouTube channel a lot more and all the cool stuff we're doing. And definitely, the next 2 podcasts are probably going to be some of the live stream that we did. So hopefully you enjoy some of that, or you can make the live stream live on Wednesday, March 19th, 10:30 Central, 11:30 Eastern time. With all of that, Sonu and I, we are traveling a little bit the next 2 weeks. We're doing a little vacation, the spring breaks and stuff. So that's why we're kind of doing the podcast that way. But we'll be back, and just reach out if we could help. Keep listening to these podcasts. Give them likes. Give them follows. Once the comments are on, give us comments. You can make fun of Sonu in the comments, but not me. That's the rule. Make fun of Sonu, but not me. But anyone who knows, just go to my X feed. Anything I say on X, people hate me. It doesn't matter what I say. Kittens are cute. I mean, you're an idiot. Like that's how social media works. But
I can't talk about kittens.
Who don't like a kitten? I don't know. Whatever. All right. With all that, everybody, we'll see you soon. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.